Hello students, welcome to EPG Pathshala. I am Ritesh Verma from Maharaja Agrasen College, University of Delhi. Today we are going to talk about on module cash flow statement, meaning, needs, preparation and interpretation from paper accounting and finance. After going through the module, students may be able to gain clarity on the meaning of cash flow statement, its needs and ways of preparation, interpretation of cash flow statement, limitations of cash flow statement. Meaning of cash flow statement. Cash flow statement is a record of inflows and outflows of cash and cash equivalents in an enterprise during a specified period of time. Cash comprises of cash in hand and demand deposits with banks. Cash equivalents are short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to insignificant risk of changes in value. Example, marketable securities, short-term investments. A cash flow statement, also known as statement of cash flows, summarizes the causes of changes in cash position of a business enterprise, both inflow and outflow. It breaks the analysis down to operating, investing, and financing activities. Introduction. Cash, the lifeblood of many organizations, is considered a vital part in the working, smooth functioning, and entire economic life of an organization. Without cash, any firm will not be able to survive for long and will collapse within some period of time itself. But sometimes, even though a concern is showing profits, it may not be able to pay its dividends and taxes. This may be due to profit earned but cash not received as yet, or cash may be drained out for some other purpose. In order to avoid this situation, proper record of cash is maintained by every concern to see the changes in cash balances between two balance sheet dates. This recorded statement is termed as a cash flow statement. Quick revision. What blood is to human body, cash is to an organization. Cash flow statement is a statement reflecting inflows or outflows of cash and cash equivalents within a specified time period. Cash flow statement is prepared on cash basis of accounting. Cash flow statement is prepared as a complementary information to income statement and balance sheet. Cash flows are classified into operating, investing, and financing activities. Need for preparing cash flow statement. The need to prepare cash flow statement arose to know the frequent changes in cash. In order to judge the liquidity position of the firm, that is the short-term paying capacity. In order to know how various activities such as building inventory, letting receivables grow, paying suppliers more quickly, and paying bank loans affect the cash. To find whether a business is running out of money even if it is profitable at the same time. Quick revision. Cash flow statement is prepared as per Accounting Standard 3 revised. cash flow statement is needed to know the liquidity position, to find out how frequently cash is changing, to reveal if business is running short of money, to study the effect of various activities on cash. Classification of cash flows. The statement of cash has three distinct sections. First, operating activities. It includes revenue producing activities. Second, investing activities. It includes activities from purchase or sale of long-term investment and property. Third is financing activities. These activities reports issuance and repurchase of companies' own bonds and stocks and the payment of dividends. Indirect method. This method is also known as reconciliation method, as it involves reconciliation of net profit or loss as given in profit and loss account and the net cash flow from operating activities as shown in the cash flow statement. Format of indirect method. In this format, we prepare three columns. First column is of particulars and second and third column is of amount column. So, first item to be written in the particulars column is cash flows from operating activities. Under this heading, we include following items. Net profit as per profit and loss account, or difference between closing balance and opening balance of profit and loss account. We add to this transfer to general reserve, proposed dividend for current year, interim dividend paid during the year, provision for tax made during the current year, extraordinary items, if any, debited to profit and loss account, and we deduct the following items: extraordinary items, if any, credited to profit and loss account, refund of tax credited to profit and loss account, and this gives us net profit before taxation, dividend and extraordinary items. We'll write this amount in the outer column of the amount. Now next, we'll do adjustment for non-cash and non-operating items. Here we'll add depreciation, preliminary expenses, discount on issue of shares and debentures written off, interest on borrowings and debentures, loss on sale of fixed assets, and will deduct following items out of this: interest income received, dividend income received, rental income received, profit on sale of fixed asset, and operating profits before working capital changes or adjustment related to changes in current assets and current liabilities. Will add decrease in current assets and increase in current liabilities. Will deduct increase in current assets and decrease in current liabilities, and the outcome will be cash generated from operations. We'll write this cash generated from operation amount on the outer column, and we'll deduct income tax paid out of it, and we'll adjust extraordinary items in it. This will give net cash inflow outflow from operating activities. Now cash flow from investing activities. This is second part of cash flow statement. We'll add proceeds from sale of fixed assets, and proceeds from sale of investments and proceeds from sale of intangible assets, interest, and dividend reserved. Will deduct rent income, purchase of fixed asset, purchase of investment, purchase of intangible assets like goodwill, and will adjust extraordinary items advanced. This will give us net cash inflow or outflow from investing activities. Third part of cash flow statement, cash flow from financing activities. Will add proceeds from issue of shares and debentures, proceeds from long-term borrowing loans, and will deduct final dividend fund, interim dividend fund, interest on debentures and loans paid, repayment of loans, redemption of debenture preference shares, and adjust extraordinary items into this. This will give us net cash inflow or outflow from financing activities. So to find out net increase or decrease in cash and cash equivalent, we'll add all these three main headings. First one was cash flow from operating activities. Second one was cash flow from investing activities. And third one was cash flow from financing activities. Now, next part in cash flow statement is we'll add cash and cash equivalents in the beginning of the year. That is cash in hand, cash at bank, by bank overdraft, short-term deposits, marketable securities, and will deduct cash and cash equivalents at the end of the year, such as cash in hand, cash at bank by bank overdraft, short-term deposits, marketable securities, and the final outcome will arrive at net cash increase or decrease. Explanation. The preparation is started with the amount of net profit as per profit and loss account. Transfer to reserve, proposed dividend, interim dividend, and extraordinary items are added to the net profit. Adjustment for non-cash and non-operating items such as depreciation, preliminary expenses, loss on sale of fixed assets, interest received, dividend received, etc. are made, hence arriving at the operating profit before working capital changes. Adjustments related to changes in current assets and liabilities are made to the earlier arrived operating profit, net result being cash generated from operations, from which income tax is paid, and hence arriving at net proceeds from operating activities. The next step is to find the cash flow from investing activities. The proceeds from sale of land, machinery, etc. are added and purchase of fixed assets are subtracted. Next involves adjusting the financing activities by adding inflow proceeds from issue of shares and debentures and other long-term borrowings, and subtracting those which decrease the cash balance such as dividend declaration and loan repayment. Finally, by adding the above proceeds, the net inflow or outflow of cash for one specified period are determined. Quick revision. Only listed companies are required to prepare cash flow statement under indirect method as per Accounting Standard 3. As per Companies Act 2013, preparation of cash flow statement has been made mandatory for the companies. Indirect method is also known as reconciliation method, as it reconciles the net profit as per profit and loss account and the net cash from operating activities. The accounting period for cash flow statement is the same for which profit and loss account and balance sheet are prepared. Preparation of cash flow statement. Earlier, under Companies Act 1956, presentation of cash flow statement along with the final accounts was not mandatory. The revised Companies Act 2013 made cash flow statement a mandatory part of the financial statement. Since the Companies Act 2013 does not lay down any format for presentation of cash flow statement, companies will need to follow Accounting Standard 3 in this regard. In case of the listed companies, the listing agreement requires the indirect method of preparing cash flow statement, whereas the non-listed companies will have a choice of either applying direct or indirect method for preparation of cash flow statement. Cash flow statement can be prepared either by indirect method or by direct method. Direct method. As per Accounting Standard 3 revised, non-listed companies are given a choice to follow direct method or indirect method. This method is straightforward and easy to follow. It sorts all the company transactions and summarizes them into categories of operating cash receipts and operating cash payments. Format of direct method. This format is prepared by drawing three columns. First column is of particulars, second column and third column are of amounts column. The amount columns, one is inner amount column and another one is outer amount column. The first item to be written in particular size is cash flow from operating activities. In it, we'll write in A part of cash flow from operating activities, operating cash receipts in the inner column, cash sales again in the inner column, cash receipts from customers, trading commission received, royalties received in the inner column. Now we'll deduct from these operating cash receipts operating cash payments such as cash purchase, cash paid to the supplier, cash paid for business expenses like office expense, manufacturing expenses, selling and distribution expenses, and we'll find cash generated from operations by deducting A from B, that is by deducting operating cash receipts from operating cash payments, and we'll write this amount in the outer column of amount. Now next part is D part. Here we'll deduct income tax paid or net of tax refund received, and we'll write or adjust this amount in the outer column of amount. Next E part is cash flow before extraordinary items. We'll write this amount in the outer amount column. F part, next adjusted extraordinary items, receipts or payments. So we'll adjust any extraordinary item in the outer amount column, and G or final net cash flow inflow or outflow from operating activities will be written in the outer amount column. Now after cash flow from operating activities which we just found out, we'll move on to second part of cash flow statement, that is cash flow from investing activities. So calculation of all these cash flow from investing activities is similar as under the indirect method. We'll write this amount in the outer amount column. Next, third part of cash flow statement by direct method is cash flow from financing activities. Here again calculation is same as under indirect method. We'll write this amount in the outer column of the amount. Next, fourth part is net increase or decrease in cash and cash equivalents. We'll arrive at this amount by adding cash flow from operating activities and cash flow from investing activities and cash flow from financing activities and write this amount in the outer amount column. Next part is we'll add cash and cash equivalents in the beginning of the year, which is again same calculation is same as under indirect method, and we'll write this amount in the inner column. The next part is we'll deduct cash under cash equivalents in the end of the year and write this amount in the inner column, and we'll write the final calculation in the outer column. Explanation. While following the direct method, net profit as per profit and loss account is not taken into consideration. The sum total of operating cash receipts subtracted from cash payments brings us to the cash generated from operations. Adjustments for depreciation, amortization of fictitious and intangible assets, gain or loss on sale of fixed assets and investments, and transfer of general reserve are not made because operating cash receipts and payments are reported directly on the cash flow statement. The remaining steps for calculating cash flows from operating and investing activities are same as that under the indirect method. The only difference between these two methods is the dealing with the operating activities and the steps involved in obtaining the cash inflow or outflow from operating activities. Quick revision. Under direct method, cash receipts from operating revenues and cash payments from operating expenses are calculated to arrive at cash flows from operating activities. The gross cash receipts and payments may be obtained from accounting records of the enterprise. There is no need to make any adjustments for depreciation, amortization of fictitious and intangible assets, transfer to general reserve, etc. under direct method. Treatment of some special terms. First, payment of interim dividends. The amount of interim dividend paid during the year is shown as cash outflow. It will be added back to the profits for the purpose of calculating cash inflow or outflow from operating activities. Second, proposed dividend. As it is a non-operating item, it is added back to the current year profit. Third, purchase or sale of fixed assets. The balance of fixed assets appearing on two balance sheet dates helps in deciding whether the asset has been sold or purchased. Provision for taxation. Sometimes the only information about provision for taxation is the amount in opening and closing balance sheet. In such a case, the figures appearing in the opening balance sheet is treated as an outflow of cash, hence subtracted, while figure in the closing balance sheet is considered as a non-cash expense and added back to the net income to find cash from operating activities. Next, acquisition and disposals of subsidiaries and other business units. The cash outflows arising from acquisition and disposal of subsidiaries or other business units should be presented separately and presented under investing activities. Interpretation of cash flow statement. Certain points of interpretation are discussed here. If a firm has more inflows than outflows, it is an indication that the firm has an ability to increase its dividend payments, repurchase its stocks, or reduce its debts. All this is a positive indication for the firm. Cash flows from operating activities is a key indicator of the extent to whether the operations have generated sufficient cash to maintain the operating capability of an enterprise or not. So, the positive and higher the cash flow from operating activities, the better it is for the firm, and thus indicating a good sign of potential growth. In case the firm reports growth on its income statement but has a negative cash flow, it may be interpreted as the firm lacking the ability to translate its growth into cash. If cash flows from investing activities show a negative balance, it would mean that enough cash is generated to invest in non-current assets and that the firm is aiming to replace its obsolete technology. Quick revision. Interim dividend is treated as cash outflow and added back to the profits. Proposed dividend, being a non-operating item, is added back to the current year profit. Balances of fixed assets in two balance sheet dates reveals whether it has been purchased or sold. Cash from acquisition or disposal from subsidiaries is shown separately and included under the investing activities. More cash inflows means increase in the ability of the firm to pay out its dividends, reduce debt, and repurchase its bonds or shares. Limitations of cash flow statement. Cash flow statement is prepared under the cash basis of accounting. Therefore, it ignores the basic accounting concept of accrual basis. It is not suitable for judging profitability of any concern as it is not takes into consideration the non-cash charges. So students, let's now summarize what we have learned in this module. Cash is the fuel which helps the engine of business to run for a longer period of time. Without adequate cash, no firm will be able to function for long. For adequate maintenance of cash, proper record of the incoming and outgoing of cash is kept. This is done in the form of cash flow statement. Cash flow statement means a guide map which guides the organization about the changes in cash balances over a specified period of time. It summarizes the cash movement into three categories of operating, investing, and financing activities. Cash flow statement is prepared by two methods, direct method and indirect method. The need for preparing cash flow statement is realized in order to judge the liquidity position of the firm, to find out how frequently cash is changing, to find the incoming sources of cash and find where it is being utilized. It also reveals if the firm is running out of cash or not. Despite of its importance, it is not considered adequate for judging the profitability as it ignores the accrual basis of accounting and ignores the non-cash charges while calculating cash flow from operating activities. Thank you.